There have been a ton of YouTube videos lately coming out, creators and analysts covering a potential collapse or an implosion of the Airbnb market and short-term rental markets in general. So I'd like to share a video with you, and it's a little bit longer than usual, but I'd like us to watch it and put out our reaction to it. All right, so this video is by EconoFin. Shout out to EconoFin. I watched this and he gives a lot of data points and research into why he came up with this thesis. So I think it's it's worth a watch.
The short-term rental market is on the verge of total collapse. What happens next will send shockwaves through the entire housing market. Over 2 million Airbnb and VRBO properties are about to flood the housing market simultaneously, creating the single biggest inventory surge in real estate history. I don't make these claims lightly. The data we're about to share with you has been meticulously gathered from multiple industry sources, property management systems, and financial institutions, and the picture it paints is undeniable. If you've been waiting on the sidelines for the right time to buy, or if you're an investor trying to protect what you've built, what we're about to show you could fundamentally change your investment strategy for the next decade. We've never seen anything like what's unfolding right now. Let me be absolutely clear. This is not speculation. These are the cold, hard numbers that the real estate industry and major short-term rental platforms don't want you to see. The short-term rental market is facing a perfect storm of 5 critical factors, all converging at once. First, occupancy rates have plummeted across the board. According to AirDNA's latest market report, the national average occupancy rate for short-term rentals has fallen to just 48.3%, down from 61.7% in 2022. In popular markets like Phoenix, Miami, and Nashville, the decline is even more severe, with occupancy rates dropping below 40%. Second, operational costs have skyrocketed. Property insurance for short-term rentals has increased by an average of 34.2% nationally since 2023. Many investors are seeing increases of 150% or more, if they can get coverage at all. Maintenance costs, cleaning services, and property management fees have all seen double-digit increases. Third, new local regulations are crushing profit margins. In the past 18 months alone, 342 cities and counties have implemented new restrictions on short-term rentals. These range from outright bans to strict occupancy limits, mandatory safety upgrades, and special tax designations. Fourth, we're seeing unprecedented market saturation. The total number of active listings on Airbnb and VRBO has increased by 23.8% year over year, even as demand has decreased by 12.4%. Simple economics tell us what happens next: lower prices and margin compression. Fifth, and this is the critical factor most analysts are missing, the financing structures underpinning much of this market are starting to unravel. To understand the magnitude of what's coming, you need to understand how many of these properties were financed. During the pandemic-era real estate boom of 2020 to 2022, interest rates were at historic lows. The average 30-year fixed mortgage bottomed out at 2.65% in January 2021. This created a gold rush mentality among investors looking to capitalize on the growing short-term rental market. According to data from the National Association of Realtors, approximately 28% of all homes purchased in 2021 were bought by investors, the highest percentage ever recorded. Of those investor purchases, our analysis indicates that roughly 37% were intended for use as short-term rentals. But here's where it gets interesting. Many of these investors used creative financing structures to acquire multiple properties rapidly. The most common strategies included cash-out refinances on existing properties to fund down payments on new acquisitions, cross-collateralization of multiple properties, interest-only loans with balloon payments, private lending with 3 to 5 year terms, and home equity lines of credit used for down payment. The problem? Many of these financing arrangements are coming due for renewal or refinancing right now, in an environment where interest rates have more than doubled and property values and vacation markets are declining. Our analysis of loan data from leading mortgage services shows that approximately $318 billion in loans connected to short-term rental properties will either adjust rates or require refinancing between now and the end of 2025. With current
All right, that's cool. That's a good place to stop.
Hmm.
Quick recap, 5 critical factors creating a perfect storm. He said occupancy rates are down across the board, operating expenses increased over 30%, new local regulations increase cost of ownership, which can include like insurance,
Hmm.
market saturation. And then the last one is financing structures unraveling. Cash out refis for down payments, cross collateralization, interest only loans, private lending with short terms, and HELOCs that are coming up on repayment periods. So these are all like COVID era investment purchases that are now coming upon a period where they need to either refinance, start coming up with principal payments. I know that we do a lot, we do everything here: purchases, refinances, and we have a lot of investment customers that have taken out equity from their primary residence or from another investment property to do more investments.
Yeah, I mean, it's how you're going to strategically deploy capital or working capital and what your plan is. So I see seasoned investors doing every single thing that you mentioned in that video. They literally took out cash from their portfolios. They've cross collateralized whole projects or communities that they have properties in. They've left some of them leveraged interest only loans. A lot of them leverage private lending options with 3 to 5 year terms and HELOCs, right?
Hmm.
But it's not necessarily bad to do that because there's a pro and con to everything. My really seasoned investors didn't go over like 50 or 60% of the actual appraised value of the collateral or asset. So they left a lot of
Okay.
equity in place because
Hmm.
number one, they were focused on appreciation and cash flow, not just
Mm.
one or the other. So they left room in case there was a market correction. And they also gave themselves plenty of room in case rents weren't able to be pushed up and they came down
Mm.
as well so that they still cash flowed. So those investors that I know are seeing this current market, they're not seeing it as a negative for their portfolio. They've actually already hedged for that. And they're
Mm.
playing the long game. So, if anything, they're getting ready to deploy the capital that they've been sitting on now for the last 2 years and reinvesting
Hmm.
to probably double their portfolio size. I could think of a gentleman out in Barstow that has about 150 units. He's
Cool.
probably getting ready because he's seeing it as an opportunity because as a smart buyer, you're not just waiting for the bottom, right? They're waiting for that
Hmm.
motivated seller that didn't prepare or hedge like they have to
Hmm.
expand and build on their portfolio. So it's not just getting or knowing when that bottom is going to be hit in that market. It's really just a spread of like where you're trying to capitalize in between, like buying at the right time and then cashing out and then leveraging that equity again.
Right, yeah. Just to reiterate, cash out refis, cross collateralization, these are not bad in and of itself. It's just how you're doing it, right? So are you doing it all in, like YOLOing into these investments and
Yeah.
stretching yourself to the limit, or are you doing it like your buyer was doing it, methodically and understanding that we are in a boom cycle and a bust cycle eventually will come.
Yeah. So I mean, I think it comes down to people with experience, right? They've seen multiple. Anybody that's seen multiple market cycles in real estate that are still actively investing right now through rentals and building their portfolio. It's they know they shouldn't be maxing out
Mm,
whatever the appraised value is. So if you had $1 million portfolio, you're not going to max it out to 80%, right? Because now you have
hmm.
no room in case there's a market correction like you're seeing in Florida and the like Austin, and they're down like 30%. So you're already underwater. So like it's preparing, right? It's being smart about it. And you can't just think past performance will guarantee future results, right? So in the
Hmm.
past, during the pandemic, we saw 2.5, or in that report, 2.6% interest rate. There's no way we're going to see another cycle of a 2.6 interest rate. So, if anything, I think the best we'll see is a five, maybe a break into the fours, right, in the near
Hmm.
future. So
Yeah.
I think that you said there's like what 5 million, like 2 million homes or 5 million homes that are about to hit the market, Peter. Is that right?
No, 5 million loans that need to be refinanced or come due.
I mean, if you're watching us, we can help you with those refinances into long-term notes. I mean, we're flexible when it comes to helping you qualify for it because I'm seeing a lot of it right now too. It's the problem with a lot of these DSCR loans with short-term rentals or mid-term rentals is even with long-term rents and low minimum cash flow requirements, we're not seeing a cash flow because the appraisals are saying it's a depressed market, right? So it's getting tighter with the lending side too to qualify you for it. So you need two things: either a lender that understands and has the right programs to fix or plan for what's going to come in the next 6 months to a year for a lot of people. Because if these loans are coming due because your short-term note with the bridge finance is maturing because you're at the 3 year mark and you have to make a decision. I'm actually seeing a couple of these pop up more as well too. So it's a matter of planning long term. So I know one of our videos we talked about non-QM DSCR loans in the beginning. So this is a challenging time. It's you have a non-qualified property because it's not cash flowing, and you need to
Hmm.
find a long-term fix for it in a depressed market cycle. So what's your contingency plan moving forward to make sure you can keep that property or make it profitable for you in the future?
That brings up a few questions. So for a DSCR loan, if it was cash flowing when you pull the loan, but like 3, 4, 5 years later down the line, it's not cash flowing, what happens to that loan? Does it get recalled?
And it doesn't get recalled because it's not cash flowing because you qualified based on the ability for it to repay the loan. So if it's negative cash flow, it's coming out of your pocket as a borrower. But how long can you sustain a negative cash flow if that's the case? It's either A, going to sell it under market, or B, put up with it for however long, or C, refinance it so that it at least breaks even or cash flows, right? So luckily right now, if you're in a good equity position with the property, you can still cash flow. So in my opinion, those people are going to either sell it to someone that sees that as an opportunity and
Hmm.
acquire it and have it cash flow because they're buying it under market at a
Lower
really good
price, yeah.
price, or
Hmm.
you're going to have to come up with a contingency plan and then maybe take a HELOC from another property or your primary to bring that down so that it cash flows, right? So you might get a better term with the HELOC on your primary for that to cover the equity gap on your rental, right? You're gonna have to get creative, in my opinion. So it's like your income might have been 5,000 a month with a short-term rental, but if it's down half the occupancy what it was normally, then now you're at 2,500 bucks. So that math doesn't math to
Hmm.
maintain it. So you're going to have to come up with a long-term strategy instead of a short-term rental strategy. So it's sell or refinance it and then see if that covers the gap. If not, you're going to have to
Yeah.
make the decision to sell it. And then one of my customers will probably end up buying it. So it's just it's an unfortunate circle if you didn't plan for it.
Yeah, and that brings us to another point that this real estate investing game is a long-term horizon. It's not like stocks or even cryptocurrency where you hold it for a few years and you make, a good
Mm,
return on it. It's really if you want to grow your wealth through real estate, you have to think in decades, right?
I think so. Like I don't see anyone with passive real estate that make it in like a couple years, unless you're just
Hmm.
the luckiest person ever. And I'm grateful my parents gave me that first experience probably back in the early 2000s. Like it wasn't for me to buy my own home or sell it, but they actually gave me the opportunity to lead the whole process of buying and selling a home for them, on and their portfolio at
Oh,
that time.
interesting.
So I learned a lot.
Yeah, that's really cool. So your parents kind of let you spearhead that whole transaction process and they as a
Yeah,
training method?
I got the chance to interview real estate agents, see who I wanted
Oh,
to work
wow.
with, get a home listed, open house set up, scheduling all of that with the realtor, and then the whole negotiation process of rejecting offers, accepting offers.
Is that where you got the negotiation bug from? 'Cause I remember a long time ago you told me that you like to go on your like free time to car dealers and just negotiate.
Yeah, it was fun. It's like every opportunity I had a chance to like make a deal, right? I mean,
Let's see.
have you heard about the other stuff too, like fractional ownership as an exit strategy?
Yes.
What are your thoughts about that?
Fractional ownership as an exit strategy. I actually know some people who have bought a home with their friends. Like up in San Francisco, they got together a group of they're like college kids, right? But they didn't really have a lot of money. They pulled their savings together. I think there was like 12 of them or something, and they bought a house and they decided to like live in one room each or something. And they all made a contract, they made an LLC, and I thought it was really like a really interesting learning experience for them. I didn't think that this would be a widespread financial tool for people to exit or to actually enter
Hmm.
into the market. But yeah, I'm seeing that more and more, like any asset, you can divvy it up into fractions and own it as long as you have the right paperwork and structure, legal structure to do that. So yeah, why not? If you have a group of friends that, hey, like I'm falling on hard times, I trust you. Do you want to share the burden with me and then also share the upside with me later? Yeah, why not?
Yeah, I mean, I see a lot of them in like Newport Beach or like when I check Redfin, it's like I see these homes like on the coast, like a Balboa, have fractional ownership. Like I can see that in luxury markets as a temporary solution, like you said, with friends, like minds, same go through the same burden at this time, but you see the upside potential, right? And then you have the ability to relinquish that ownership share at that time in the future.
Yeah, and
Makes sense.
you get a lawyer, you hire them, for to build that contract out, go through all the questions. What's the exit strategy for each person? What's the like who has the manager control? Like how do you vote on decisions? What if someone wants change of life, right? Someone wants to exit, and then how do you replace that? All that stuff, as long as you take care of it on a contract, just like a marriage, right? Like, do you sign a prenup or not? Any business a merger, M&A, you have to do the same thing. When you go buy a business, how do you exit? How do you pay? When do you pay? How much? Um, yeah, you can do that with anything.
Yeah, it sounds like a unique temporary solution, but I don't know if would you want to
Isn't it
invest?
this? Isn't it the same thing as like a timeshare? It's essentially the same structure, isn't
Yeah, but timeshare is not worth anything at the end of the day. I don't want to say the four-letter word, but
it? Like the concept of a timeshare, you know what I
concept
mean,
of a
right?
timeshare.
Like so like you have a bunch of investors coming into one asset, one property, and then everyone has usage to it. Or let's just say no one has usage to it, but they all have, if it cash flows, they all get a split of that cash flow and the equity, however
Then that
way
would be like
they've
a
divvied
joint
it up.
venture. It'd be like a rate, right? Like a real estate investment trust, or like say for example,
Yeah,
like a group
on a small
maybe came
scale.
together to buy a hotel. But I don't think five people should be going out. Not trying to discriminate, but like rentals out that are suffering in those regions right now. I don't think you're going to see five people want to split that, right? To acquire it.
It could be like as an exit strategy specifically for what we're seeing in Florida, let's say, where home values have dropped, you know,
Mhm.
dozens of percentages, then maybe it's like, hey, mom and dad, I'm I need someone to
I
bail
don't
me
know.
out. Can
I,
you can you
I need
factional
I need parents like that then. Hey mom and dad, I'm seeing this whole region fall apart. Can I borrow $100 million so I can buy everything?
no, as an exit strategy. So like they already had um like three, four homes that they've invested in, but now they're 30% less or 50% less in
Yeah.
value. They don't want to sell it at a loss, but they need to refinance it, right? So what do? They go into fractional ownership with a couple
Hmm.
other people, um, build up the equity, refinance, and then they can put cash flow at a higher rate or something.
I'll be honest. Like I don't know if it's just me jumping off topic again because like I keep thinking like if the short-term rental market's falling like it has, and people are exiting it, and there are going to be less units and more people that actually need starter homes are getting into it. Because when I think of some like Airbnbs, I think those are like the accessible homes because they're like vacation rentals,
Hmm.
right, in good areas,
Yeah.
or
Yeah.
there has to be opportunity. And if the bad side, yes, as an investor, it sucks to see your investment fail, right? But also the flip side is because those homes are no longer being held by investors, and will that open up the opportunity for first time home buyers to actually
For
get
sure.
a starter home now at a fair price? And a
Hmm.
lot of these Airbnbs, they were renovated pretty decently, so it's like
Yeah.
you might get some really good deals and opportunities if you don't you don't miss it, right? You don't snooze on it because
Oh, for sure. Yeah. Once if this actually does happen, the Airbnb and Vrbo market, once they collapse, I think first-time home buyers purchases is gonna just it's gonna
I
skyrocket.
think it's going to be an opportunity. I think it's going to be a real opportunity on that front. I don't think it's
Hmm.
going to be a full-on collapse in Airbnb and VRBO because I'm seeing there's a huge demand for them, the right ones. But I think it's going
Hmm.
to be a
Hmm.
consolidation of market with really pro-level hosts that are on par with competing with like luxury hotel brands, 4 or 5 stars.
Do you think the hotel businesses will ever get into the short-term rental business for like
I think they
Airbnbs?
already are,
C-
Peter.
You think they already are?
I think they already are
I haven't
because
done
like
any
if you
research
have
on this,
like
just
if you look up
completely off the top of my head. Uh-huh.
like I don't because I when I search like I'm trying to hit a hotel status with a specific chain this year, right? Because I have
Hmm.
a couple pretty big trips coming up for the second half of the year. So when I search for them, right, they have things like outdoor retreat or vacation. They don't call it a vacation rental, but it looks like a VRBO or that they
Yeah.
offer. Like, and then they're like
Yeah, yeah.
promoting it. So it's like this chain says if you stay at one of our outdoor like Yosemite locations, it's not one of their hotel chains. You get double night rewards or something, and it's like, and they make it a whole experience. So it's not just a hotel. It's like I'm pretty sure it's a vacation rental type thing they have, and they call it an experience, and it looks really well groomed and polished. So I wouldn't be surprised. Maybe the hotel chains will start buying up some of these Airbnbs if they come up, so they can
Yeah, that would be
capitalize
unfortunate
on the
if that
market.
really happens, especially in Florida because dude, like Disney World is there, Universal
Mhm.
Studios is there, like it's a vacation destination. So like people, they're gonna keep going to Florida
Mhm.
for vacations for short term, right? So if hotels are the ones with the money and they're buying up a lot of
At a good deal, maybe,
the
right?
cheap, yeah, like 50% off homes from the highs, yeah,
Mhm.
that
Or fingers crossed, we get to see first-time home buyers finally have more access to homes at a fair price.
yes. Or retire people, like if
Mm.
like my parents are getting close to retirement. If I don't know if Florida is a downgrade or an upgrade from California, but if they want to move over to Florida, uh, you know, at a really good price at a reasonably sized home, yeah, why not? It's a great location to retire.
Yeah, absolutely, absolutely.
Hmm. A lot of cool things coming up, a lot of pain, but a lot of opportunities at the same time. So hopefully, there's ways for the pain to be mitigated, and there's hopefully a lot of opportunity for first-time home buyers or people that have been stuck in the place that they've been stuck for a long time to finally be able to relocate or to move on and to start new chapters in their life or even start new investments. So we're definitely excited for the future. And if you need help from experienced mortgage brokers to help you strategize or to help you look for good deals on the market, you know where to find us. We're the Clear Close. We're on Instagram, on YouTube, and we're going to be on TikTok and Spotify. I'm working on that. Um, and that's it for the show today. So please leave a comment, subscribe, and share this video with someone who you think will benefit from it. And we'll catch you on the next one. Bye.